In the early hours of December 30th, 2025, the financial world awoke to a shock that reverberated across trading floors from New York to Shanghai. JP Morgan, AS Silver Holdings, had suffered a catastrophic collapse, resulting in a staggering $31 billion loss. What initially appeared as a routine market correction quickly escalated into one of the most significant liquidity events in modern precious metals history, highlighting systemic vulnerabilities in both bullion markets and derivative trading mechanisms. JP Morgan, long regarded as a cornerstone of the global silver market, found itself exposed in a way that few analysts had anticipated, with ripple effects impacting hedge funds, industrial players, and central banks. For decades, JP Morgan has played a dual role in the market, maintaining large physical silver inventories across vaults in London, New York, and Singapore, while simultaneously holding leveraged positions in silver futures and over-the-counter derivatives. This dual strategy has historically allowed the bank to influence spot pricing and provide liquidity to institutional clients, effectively acting as both market stabilizer and profit generator. The collapse of $31 billion demonstrates how even sophisticated risk management systems can be overwhelmed when market conditions deviate from modeled assumptions. Estimates suggest that JP Morgan controls nearly 35–40% of the global silver futures market through a combination of proprietary and client positions, making any misstep potentially catastrophic not only for the bank, but for the global commodity ecosystem. Silver OAS' unique role as both a precious metal and an industrial commodity introduces additional layers of complexity, as surges in industrial demand for electronics, solar panels, and other high-conductivity applications can sharply impact spot prices and delivery obligations. The December 2025 event was triggered by a confluence of factors, including unprecedented industrial demand from Asian markets, particularly China, which drove premiums for physical silver well above futures prices and liquidity stress within Western financial institutions, facing simultaneous margin calls. JP Morgan had been holding both long and short positions in silver across COMEX and OTC markets, with long contracts designed to profit from upward price movements and shorts intended as hedges against price declines. However, the rapid surge in spot silver pricing, combined with tight physical supply, created a market squeeze that rendered traditional hedges ineffective. Margin calls escalated quickly, forcing the bank to liquidate positions at unfavorable prices, which in turn drove futures prices down, creating a feedback loop that amplified losses. The macroeconomic environment exacerbated these pressures. Rising industrial demand in Asia, combined with liquidity injections by central banks in response to regional banking stress, produced a paradoxical scenario, where higher interest rates coexisted with an influx of cash-seeking physical silver, further misaligning derivative strategies with actual market dynamics. Shanghai's bullion exchanges, increasingly influential in global pricing, reflected premiums far above COMEX levels, a factor that JP Morgan's models had underestimated, leaving the bank vulnerable to physical delivery obligations that exceeded its collateral capacity. The immediate impact on the market was dramatic. Silver futures and spot prices exhibited unprecedented intraday volatility, with spreads between spot and futures reaching levels unseen in decades. Investor sentiment across hedge funds and ETFs shifted rapidly as forced liquidations and margin pressures extended into related commodity markets. The collapse also triggered scrutiny from regulators, including the SEC, CFTC, and the Bank for International Settlements, raising questions about risk management, transparency in derivatives reporting, and the adequacy of liquidity buffers. For investors, the lesson is stark. Leverage magnifies risk. Interdependencies between physical and derivative markets can create systemic vulnerabilities. Liquidity remains the ultimate safeguard, and transparency in derivative structures is crucial for understanding counterparty risk. JP Morgan's $31 billion loss serves as a wake-up call, highlighting structural fragilities in global silver markets and the cascading consequences of over-leveraged positions. This event is not merely an isolated institutional failure. It is indicative of broader market dynamics where industrial demand, regulatory frameworks, liquidity constraints, and cross-border trading interconnect in ways that can rapidly amplify risk. The collapse underscores that even the largest and most sophisticated institutions are susceptible to market forces beyond their immediate control, and that silver, with its dual role as both a precious and industrial metal, remains an asset class where volatility is both inherent and persistent. The ongoing repercussions are likely to influence regulatory policy, trading strategies, and investor behavior well into 2026, as market participants reassess exposure to both physical bullion and derivative instruments. While JP Morgan's immediate losses are staggering, the event also serves as a case study in modern market mechanics, risk management pitfalls, and the evolving dynamics of global commodity trading. Investors, regulators, and analysts alike are left to examine the intersection of leverage, liquidity, industrial demand, and cross-market interdependencies that converged in this historic silver market collapse, drawing lessons that will shape strategies, oversight, and risk modeling for years to come. As the news of JP Morgan's $31 billion silver collapse reverberated through financial markets, investors, regulators, and analysts scrambled to understand not only the immediate mechanics behind the event, but also the potential long-term implications for the global precious metals ecosystem. At the heart of the matter were JP Morgan's derivative positions, which had been constructed over multiple years with layers of hedging designed to protect against price volatility while simultaneously generating profits. The bank's holdings included a combination of futures contracts, options, and over-the-counter agreements, some of which were highly leveraged and contingent on specific price ranges and delivery timelines. The failure occurred when physical demand, particularly from Asian industrial and bullion markets, diverged sharply from modeled assumptions, creating a structural misalignment that forced rapid liquidations and margin calls. This unanticipated squeeze exposed weaknesses in the bank's risk models, particularly in the treatment of cross-border price differentials between COMEX and Shanghai exchanges, and highlighted the interconnected nature of derivative and physical silver markets. The collapse prompted immediate reactions from market participants. Hedge funds with correlated exposure began liquidating positions to protect capital, ETFs with leveraged silver exposure faced redemption pressures, and industrial consumers reconsidered sourcing strategies as spot premiums rose dramatically. Analysts observed that the volatility spike and forced liquidations led to temporary dislocations in related commodities, including gold and platinum, as market participants sought alternative stores of value. JP Morgan's internal risk management teams, though highly experienced, were unable to anticipate the convergence of extreme market volatility, rapid physical demand surges, and liquidity constraints, illustrating that even sophisticated institutions are vulnerable when multiple stress factors align simultaneously. Regulators quickly took notice. The SEC and CFTC launched inquiries into the adequacy of reporting mechanisms, collateral requirements, and derivative transparency, while the Bank for International Settlements assessed systemic risk implications for other global banking institutions. The event sparked discussions about potential reforms, including more stringent margin requirements, increased disclosure of derivative exposures, and stress testing for cross-market interdependencies. For professional investors, the collapse provides critical lessons in market risk and portfolio management. First, leverage magnifies exposure in ways that are not always intuitive. Second, industrial demand and spot market dynamics can rapidly outpace modeled predictions. Third, liquidity management is paramount, particularly when operating across multiple geographies with divergent market behaviors. And fourth, counterparty risk in derivative transactions must be continuously monitored as cascading failures can propagate faster than any hedging strategy can react. Looking ahead into 2026, silver markets are expected to experience continued volatility as institutional players reassess exposure. Physical supply constraints remain tight, and cross-border demand persists. Analysts forecast that premium spreads between physical silver in Shanghai and futures markets in COMEX may remain elevated until sufficient arbitrage opportunities are exploited or inventory imbalances are corrected. In addition, central bank policies and macroeconomic factors, such as interest rate adjustments, quantitative easing measures, and geopolitical tensions, will likely influence investor sentiment and speculative positioning in precious metals. For JP Morgan, the collapse represents both a financial loss and an opportunity to recalibrate risk frameworks, optimize hedging strategies, and strengthen liquidity buffers to mitigate future shocks. Internally, the bank is expected to conduct thorough post-mortem analyses, identifying breakdowns in risk modeling assumptions, stress testing procedures, and operational oversight. Externally, other financial institutions are likely to review their own derivative exposure to silver and related commodities, with the possibility of reduced leverage and more conservative hedging strategies becoming the norm in the near term. From a broader market perspective, this event underscores the systemic importance of transparency, liquidity, and cross-market awareness. Investors who are seeking exposure to silver, whether through futures contracts, ETFs, or physical holdings, must remain vigilant about the risks inherent in a market where supply-demand dynamics, industrial usage, and speculative positioning interact in complex ways. The collapse also highlights the growing influence of Asian bullion markets, particularly Shanghai, as both a physical hub and a pricing reference point, which can introduce volatility that Western institutions may not fully anticipate. Looking forward, experts predict a period of heightened price sensitivity where news events, margin adjustments, and geopolitical developments could trigger short-term spikes or drops in silver pricing, creating both risks and opportunities for strategic investors. Furthermore, the event raises questions about the regulatory framework governing large-scale derivative positions, as systemic vulnerabilities exposed by JP Morgan, Boreas collapse may prompt policymakers to enforce more rigorous reporting standards, liquidity requirements, and stress testing protocols across major financial institutions. For the professional investor, the key takeaway is the importance of holistic market analysis, considering not only derivative exposures, but also the interplay between physical supply, industrial demand, regulatory policies, and global macroeconomic trends. Strategies that incorporate diversified exposure, careful liquidity management, and close monitoring of counterparty risk will be essential in navigating the post-collapse landscape. JP Morgan's experience serves as a case study in the complexity of modern financial markets, demonstrating that even the largest and most sophisticated institutions are not immune to convergence risk, where multiple adverse factors align to create outsized losses. As markets adjust to this historic event, silver will remain a highly scrutinized asset, with institutional and retail investors alike paying close attention to trading volumes, premium spreads, and macroeconomic signals that could indicate the next significant move. In conclusion, the $31 billion collapse is more than an isolated financial shock. It is a reflection of structural market dynamics, derivative vulnerabilities, and the interconnectedness of global bullion markets. The lessons learned from this event will shape investment strategies, risk management practices, and regulatory frameworks for years to come, serving as a critical benchmark for understanding how liquidity leverage, industrial demand, and global interdependencies can converge to produce unprecedented market outcomes. Investors who carefully study this episode, incorporate rigorous risk assessment, and maintain flexibility in strategy are likely to be better positioned to navigate the evolving landscape of precious metals and commodities in 2026 and beyond. While those who ignore these signals may face heightened exposure to volatility and systemic shocks in the months ahead,